Wall Street Confidential here with Jim Cramer.
Simon.
Welcome back.
Yeah.
Dividends. I always thought dividends were a good thing, and you're saying maybe they're not going to help.
Well, look, I think we're in a bizarre market. I'm actually writing a piece right now about the change in the law of short selling last summer, and what it's done is make it so that you can bang a stock down, and sometimes these bang downs have failed to protect a lot of the dividend-producing stocks. So let's use Enterprise Partners, okay? EPD. This is a stock that yields 7%. I happen to know...
That's like a bond.
Right, exactly. But with some growth because there's price increases in the pipelines. This is a stock where I know a lot of people, and there was a Business Week article about some hedge funds that were, people were buying these stocks, they were getting repo money, getting that cheap money from the banks, brokers, and buying these stocks and doing the arbitrage of borrowing money at, say, 3-4%, and EPD yields 6.5%. So they're picking up that VIG. And the dividend seems very safe because, like a lot of companies that keep raising their dividends with decent balance sheets, you have a pretty good feel that things will work. I contrast this with buying Fannie Mae paper, which was another arbitrage people were doing. And suddenly, until yesterday, you didn't have the implicit guarantee. The implicit guarantee is back, which is why Fannie Mae is going from 20 to 32. What happened is we found out, and it's been in the public, that the hedge funds that were doing this are under liquidation. So if you know that, then what you would do is you would just go in and short sell them down to where each day the collateral that they have goes down, which means they have to sell. Now so
it's going to feed on itself more and more.
Now, before the change in the law in July of last year, you couldn't do this. You had to wait for buyers. But now, you know that a hedge fund's in trouble. You know that a hedge fund's down 10%. You know that there's liquidations going to occur. Why wouldn't you go into Enterprise and just sell down $500,000 every day? Just sell it. Knock it down to where the hedge fund has to liquidate it, and then you can cover. So the dividend is not supporting that stock because everyone knows that the holders are able to be cracked. There's also ETF selling. I mentioned earlier, I've mentioned another tape, BP. Okay, BP is part of an ETF on oil, so even though it's got a 5.5% yield, it doesn't matter. It can't stop an ETF raid. So the raids are making so dividends aren't holding the stocks. But this is short term.
Yeah, well, I was going to say that's reminiscent of the 30s when stocks yielded more than bonds. Because do you see a return to that long?
Yes, I mean that's interesting. That's a really good analogy because what's happened is that people can't buy stocks as swiftly as they'd like, and stock companies are only allowed to buy around 25% of the volume. So what's happened is that I know that if I was at a hedge fund and I knew that there was a hedge fund that's under liquidation and I no longer had to wait for an uptick because the SEC ridiculously got rid of the law, I don't know if I could resist not trying to break that hedge fund. I just think it would be a great way to make money. And obviously this is a known trade. And what I'm saying is that perhaps a way to be able to play this liquidation of leverage is to find the stocks that have dividends that could come back and support them that would then be better than cash, which is going down in value all the time. T-bills going down in value all the time in terms of yield. So, I mean, that's a great trade to me, it's a great investment to me, but the trade is to break these stocks. And stocks are being broken so easily now that it's 1929. It's the 30s. And the SEC was very foolish because what they didn't realize is that the hedge funds have so much money and they can target a company. All you have to do is say that you think Lehman's going under, and then a group of guys can take Lehman under.
Okay, what are those good examples, Jim?
Well, I mean, I think that you want to go by companies that have committed to increasing the dividend this year because they have big cash flow. And the two that are most etched in stone dividend increase are Verizon and AT&T. So you're shorting a 5% yielding stock. Now, typically, the only way to get that to 5.5 is for the stock to go down. But when you speak to men of their words, the people, Randall Stevenson, who runs AT&T, and Ivan Seidenberg, who runs Verizon, they've already told you they're going to raise the dividend. So these are basically bonds with coupons that are getting bigger.
Nice.
So you would want to be there for those.
Okay, cool. Thank you. Jim Cramer, Wall Street Confidential, saying buy some Verizon and AT&T.
That's your action point. Take advantage of it.